this is an ugly market. What I think is going on here is there are two factors for the market to digest. One is inflation, and that created the market to set up in certain ways. Everyone's crowded into certain themes. Then growth starts evaporating. You can see it all over the place, stuff like consumer discretionary stocks. You can see it in the forward-looking indicators. And so the market has to deal with inflation plus growth. And what that's basically mean is everyone's hit the liquidate button. So everything's getting liquidated. This is the correlation of one style markets that I was warning about. And it hits everything from crypto to pretty much everything.
Hello and welcome to Money Talks. In today's video, macro investor, cryptocurrency enthusiast, and Real Vision CEO Raoul updates about inflation, stagflation, and why we are heading into a global recession. Raoul also shares his prediction regarding global economy slowdown and why inflation will hit everything, including the cryptocurrency markets. Additionally, Raoul makes a serious warning about liquidation in the markets. So without wasting any time, let's dive right into the video.
So there is a massive liquidation going on as people struggle with their portfolios because basically whatever position you've got, it's wrong. and that's the pain everyone's going to have to take for a while. So I think we're at an inflection point, and a lot of people don't agree with me. So I wanted to go, that's why I did the campaign. It's like, listen, this is a really complicated macro environment, but it's very macro, right? We need to know and understand from the best people in the world what the hell is going on, because my voice is just my voice. My personal view is that we are doing the transition from inflation to growth. The next shoe to drop will be the inflation shoe. I think inflation and growth go lower, and we either head into recession. Europe looks like it's already in recession. China has been essentially in recession for a while now, but maybe coming out the other side early stage. And the US forward-looking indicators suggest, look, it's not clear it's a recession, but it's clear that the ISM is certainly headed to 50 or maybe just below, which is the ISM, the Institute of Supply Management Survey. Anything below 50 suggests that growth has stalled. Anything below 47 usually gives a recession. So we're getting in the phase where we're going to have a very slow patch, and there is no sign yet that that's turning around. So it could accelerate lower. So the recession is potentially on the cards. It's certainly on the cards in Europe. And we need to figure out, what does this even mean? What does it mean? And I think the big thing it means is bond yields are coming lower, because the inflation narrative, I think, is about to change. In the content, week 2 of the content campaign, we have interviewed, I'm so lucky to be in the position I'm in, to be able to sit down with, ask Pierre Andran, the world's best oil trader, what's going on in the oil markets, and Dwight Anderson, probably the world's most famous commodity trader, what's going on in the commodity markets. And, their view is these kind of prices will lead to demand destruction. And I think that's what we're seeing. We're seeing commodities crowding out growth. And I'm also keeping an eye on crude oil to see how it trades. A lot of people have very bullish forecasts, but I'm worried that the demand situation is not quite as good. And if crude oil does break this pattern to the downside, and it's far to be proven yet, then the inflation narrative would disappear very quickly, because inflation expectations are basically driven by the oil price, bizarrely, as if that's not the only thing that drives inflation, but that's what drives inflation expectations. That would change the narrative a lot and drive the panic into bonds. So if you've got a falling equity market, falling growth, falling inflation, well, that drives everybody into the dollar and bonds. So these are very important markets, and this is a very macro environment, and it's very, very important to understand what it is. Yeah. Now, if I'm right, and that the inflation story is going to change and growth is going to go slower, then we start shifting into a dynamic where we question what the central banks are going to be doing, and if bond yields are going to come lower, stuff that's been really beaten up, like the further end of the growthy stocks, they should be more interesting in that environment because they got killed by inflation. I think gold does pretty well. It's, interesting enough, gold and growth stocks tend to do badly as real rates start tightening, but they got to zero and it looks like the world's falling apart, just as the central bank are trying to undertake quantitative tightening or at least no QE. And if that's the case, then real rates are going negative again, if I'm right. And that's usually good for gold, crypto, long end of growth, that kind of stuff, and bad for everything that people have been in, like commodity stocks. The real economy seems to have slowed really fast. So, because what's happened is everybody built inventories because of supply backlogs, right? The right thing to do. Supply backlogs clear, demand falls because of high commodity prices and inflation. Everyone's stuck with a whole bunch of inventories that need to be liquidated.
Yeah.
That's not good. And we're seeing the supply backlogs clear because, the Port of Long Beach in the US, much clearer now. We're seeing the same with freight traffic has gone negative year on year, suggesting that the economy may slow significantly forward. So those kind of indicators, restaurants, been weak. The consumer has offset some of this by credit. So we've seen them drawing down their savings. So the savings ratio has been collapsing. But consumer credit has held up. And that's what traditionally happens in the US. They balance off savings and credit. But if people start losing jobs, then all bets are off. Again, I don't think there's anything really severe on the horizon. But let's keep an eye on it. Europe, different story here. Europe's between a rock and a hard place because of the reliance on Russian commodities, particularly on gas. And Europe's in the transition to ESG. That transition is going to take the best part of a decade before it really starts taking marginal demand away from fossil fuels. And they're steadfastly wanting to adhere to that, and I think it's the right thing to do, but they're going to have to take pain in the middle, and the pain is the economy. And what's happening is the outlet valve for that right now is the euro, which has been going down fast. We've seen the outlet valve in Japan being the yen going down fast, and we're starting to see the outlet valve in China being the RMB going down. Now, that's actually good. The rising dollar is bad in the short term because it creates funding problems, and it can slow growth significantly. But if these economies see cheaper currencies over time, it's going to create a larger deflationary wave because they're all exporting nations. I could see it in the economic data. I could see it in the positioning in the markets. I could see it in how things were trading, things like consumer discretionary versus consumer cyclicals, that kind of stuff. I could see it written large that we're going to get a slowdown. And so that's why I thought, okay, this is starting to get concerning. Now, I've been looking at this narrative developing for 9 months. Economies take a long time. There's only 9 data points, monthly economic data. But I've seen it writ large for a long time. I've been writing about it in Macro Insiders for a long time. Now, I could have taken the commodity trade, but my time horizon and my secular framework means that I tend to err on the side of the disinflationary. So I would rather take the setup and wait for this bigger setup, which I think is coming. So, yeah, I mean, it so happened that the timing got spot on. But, I use a whole group of things from secular trends, business cycle, to technical analysis and flow of funds. That's right. You don't stop technology with a recession. What you do is you might stop consumer behavior. You might stop marginal dollars flowing into developing new projects.
Yeah.
But the technological adoption of whether it's robotics or AI or space or crypto or any of these genetics, that's not going away.
Yeah.
So even if they trade sideways, they become cheap over time because the network adoption keeps growing. Now, sure, recessions can slow these things somewhat. But yes, so
the stock can get whacked in the interim, of course, as we see.
Yes, and you need to use logarithmic charts and understand that these are volatile things. So use logarithmic charts, and I like the regression channels that I use, and you look for things like monthly log charts where they get 2 standard deviations oversold, things start to become interesting. Now, for anybody interested, I kick off the entire global recession campaign with an hour-and-a-half piece where I basically mind dump everything, and there's about 50 charts. The production team hate me because I gave them so many charts, but I wanted to get across in my head everything that's here, because you can double click on any point I'm making, and I've been writing about all of these things, whether it's for decades, years, months, or weeks. That there's a big depth to it all, and I couldn't even cover. I could have spoken for 3 hours, but I got bored of looking at myself on screen, talking to myself, because I did it all in one piece to camera, as in my classic fashion.
Coming back to cryptocurrencies, Bitcoin is underperforming the S&P 500 and gold year to date, but is slightly ahead of long-term treasury bonds. There has been a persistent risk-off theme so far this year, driven by macroeconomic and geopolitical risk. Typically, investors reduce their exposure to speculative assets such as stocks and cryptos during times of uncertainty, and bond returns fall when rates rise. In contrast, gold and other commodities typically outperform when inflation rises. Bitcoin has traded in a choppy range over the past year, with a midpoint of $40,000. Despite negative year-to-date returns, the cryptocurrency is still up 16% from its January 24 low, around $33,000, compared with the S&P 500, which is trading lower so far this year. Historically, Bitcoin has generated an average return of 17% in May. Stocks are also trading in a seasonally strong period, which could provide an opportunity for buyers to enter the market after 3 months of sideways trading. Still, historical returns are no guarantee of future returns. For example, technical indicators point to a period of stabilization, albeit with a limited upside in price. And sentiment among crypto derivative traders remains mixed. So, do you agree with Raoul Pal that a global recession is imminent? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.